Another day and more delays on the 200 billion euro restructuring agreement on Greek government debt. Stephen Fidler, our Brussels chief, joins us now to follow the painful negotiations. Stephen, welcome. You know, it seems like every couple of minutes we're getting an email from people involved saying, look, things are progressing, it's all fine. But Stephen, why don't we, if that's true, have an agreement yet?
I think it's because there are more than two parties in it. It's not only Greece, which is the debtor, or its creditors, the private bondholders, but there are also other parties that are really interested, and that includes the International Monetary Fund, has got a lot of credibility on the line here, and Germany, which is the Eurozone's paymaster and has got to sort of make up the shortfalls if this deal in some way falls short.
Well, and Stephen, you point out that the IMF and Germany, aside from being the major parties involved here, have a different vision as to how this should proceed. Explain that.
Well, the IMF is really concerned about the what it calls the sustainability of Greece's debt, whether over time it can continue to service it without interruptions, without further restructurings. And it really wants to see Greece's debt go down to its official target of 120% of GDP by 2020. I mean, some people think that's already too high and is not sustainable, but that's what the IMF wants. The Germans don't really care so much about that. They want to make sure that their transfers to Greece are minimized. So in other words, you have the IMF calling for deeper debt reduction, which will bring in the official creditors, which may include the European Central Bank and also Germany and the others. And Germany wants none of that. It just wants to emphasize deficit reduction by Greece, more austerity, and more pain.
Right, and the international banks involved at the same time are trying to keep themselves from taking many of the losses. There's a question as to how much the ECB should absorb. You know, David Widener, how much longer can we afford what is more or less an impasse here?
I don't think that we're going to see any quick resolution. I think that we're going to have to afford it some way, because the reality is, it's like, unlike the U.S. bailouts, where the Treasury Department and the Fed were really calling the shots and deciding how they're going to approach it, and the government swooping in, we're talking about, dozens of countries, hundreds of creditors, and this is just Greece.
This is calculus.
Right.
The U.S. is arithmetic.
Everybody has their own sort of agenda. Germany doesn't want to put in too much. The IMF wants this GDP ratio. Everybody has their own agenda, so they're arguing all these different points, and everybody has kind of been given a seat at the table. There's nobody at the top forcing haircuts and doing that kind of thing.
And that's a great point, Stephen, especially with some of the pressure being off the bond markets, thanks to some of what the ECB has done with its loan programs. What is going to force a resolution here?
Well, there is a deadline, and that is March the 20th, which is when a 14.5 billion euro bond comes due, a Greek bond that comes due. And if Greece hasn't got its ducks in a row by then on the 20th of March, or 7 days after, because there's a 7-day grace period, it's got to shell out 14.5 billion euros, which it doesn't have. So essentially, this deal has got to be in place by then, and enough time given for a rather complicated bond exchange to take place. And 20th of March or 27th of March is really when this has got to be done. Otherwise, it all unravels. It could be very messy.
Well, Stephen, too, is part of why this is taking so long because of what this deal potentially stands for? I mean, people are looking at Portugal as potentially the next in line for needing some sort of bailout. Is the fact that this is basically going to stand as a blueprint for what else may come one of the reasons why there's so much at stake?
That's certainly one thing. I mean, there is, as said earlier, there are so many people at the table here. But the other thing is, yes, people will read across from Greece and look at the way it treated bondholders, look at the way that the ECB has reacted and what it's done, and they're reading that across to Portugal. And we're seeing Portuguese bond yields really rise considerably, some of them over 20% now, or were. So absolutely, these things set precedents for the future, and people, just because Greece is a small economy on the edge of the Eurozone, people definitely are not going to view it as an isolated case.
Well, and David, what's amazing, too, is that in terms of what this means for the U.S., until we get to the point where there's some, exogenous event where the ECB decides it's going to stop basically helping to fund a lot of these loans or whatever, you can have this huge problem and yet almost very little impact in real time on the markets or on the U.S. economy.
Well, I think now, I think now that's the case. But as we saw last year, in the latter part of the year, and in August, that things can ripple across the pond.
Yeah.
And the U.S. financial system is still very much tied to Europe.
Well, and people don't appreciate the extent to which Europe sliding into recession is going to hurt growth in global growth this year.
Well, absolutely, because they're such a huge market. I mean, and we're tied to them so closely. So I think as we get closer to this March 20th date that Stephen talks about, unless they somehow restructure that or maybe issue a new bond or whatever they need to do, then you'll see ramifications here in the U.S. because there's just no way that you can allow Greece to fail and have that huge messy situation that
Right.
Stephen talked about and not have it affect the U.S. economy.
Stephen, last word?
I think that's absolutely right. I mean, the markets are calm, as you said earlier, I think, because of the ECB and the kind of morphine it injected into the banking market. And I think the underlying problems, including Greece, number one on the agenda, remain to be resolved.
Stephen Fidler, our Brussels bureau chief. Stephen, thanks.